Hopefully everyone is good. Today's Wednesday, and as always on Wednesday, we look at the market sentiment data to get some low risk and high reward setups, as you wish to call. Today is a really nice day because yesterday we just had the CPI, so market is a little bit of on a crazy mood. We saw the US dollar, I'm gonna get there in a second, but majority of the pairs, well, 90% of the trades we had yesterday on euro dollar, pound dollar, Aussie dollar, they were profitable, except for gold. Okay, gold didn't go quite well. And today I've brought the US dollar yen because I've heard a few people wanting. I've heard that a few people wanted to me to talk about the US dollar yen. So there you have it. Okay, we're going to be looking at euro dollar. So yesterday we had a few trades. So we had euro dollar short, we had pound dollar short, we had Aussie dollar short, and we had gold, but gold we don't trade on Wednesdays. And then we had US dollar Japanese yen being requested by a bunch of people. So I've decided to bring US dollar yen today, and we can have a look onto that. Okay, so before we go any further, as usual, today's a bit of a more, it's not a 1 hour long as yesterday. Today's more shorter webinar because we're just going to go through some specific pairs, but as always, if you are looking to one specific pair, then you can just send it over to me, and I would definitely do an analysis on that pair. Okay, cool. So let's get started. Let me take this out of the way. Just a second. There you go. Cool. So first, let's go on the yesterday's trade we got. So let's go for euro dollar first. So I remember that I've mentioned about euro dollar potentially coming back down to 1.16. Okay, so I've talked about that before the release of the CPI, and I've made a very, very detailed version of the release of the CPI today, either in both, actually, in YouTube video, plus I've did as well into market analysis. Okay, so if you go into ACY website and you click into market analysis, you can see it right here. US dollar extends rally as inflation keeps it sticky, and you can read it through this blog. I'm going to send the link into the chat in a minute, and you can see why the inflation has been coming sticky. For the look like, inflation is actually cooling down when we look at the headlines, but inflation is actually very stickiness at the moment. Okay, so we had the trade on yesterday for shorting the euro against the US dollar. So basically we were shorting euros and buying US dollars, and that was mainly the reason because we expected that the inflation would come higher due to the tariffs, and that was exactly what happened actually, because we had the release at 10:30 p.m. The first 1 hour until 11:30 p.m. I was looking at the screen and nothing was happening. Like we had here 10:30 right here, and then until 11:30 nothing was happening. And then at 11:30 we had some moves. Okay, but we were right. So we were right. We were on the short side, so that was completely good. So as I say, the market would probably come back to this area. Stop losses would be above this high, and then we had this beautiful move down. So that is about let's say if you enter on this short here until 1.16, that's about 83 pips. Okay, so that's a fantastic trade, nearly 100 pips into one position of euro dollar. The other one we had was short the pound dollar. So that was an awesome trade because I literally mentioned about market will come back at this area. Stop losses we could be placing above this high or either this high. I've preferred to place the stop losses above this high due to the spread that could be widened, and we still have that floating. Okay, so we still have running at the moment, running with 58 pips. Okay, so from yesterday, we had 83 plus 58 today. That's already 141 pips. Then Aussie against the US dollar. We had that, remember that I've mentioned to everyone that we should have the break of the 65 400 to get into the trade. Okay. Oh, actually, that wasn't the 1 hour I've mentioned about. So let me come back down here. There you go. So we had we need to have the break of this area of 65 424. Okay. So we did that break, and now nearly hit a take profit, just kind of a bit. Now it's running with US dollar, Australian dollar moves it very slowly. So 70 bips, okay? So if we go here, plus 17, so that's around 160 pips in profit for today. The only loss we got was into gold. Yeah, this one. So we had a trade placed. Oh, it's not here. Okay, most likely disappeared. That's fine. Sometimes it happens. But it was around this level here. Okay, so it was around this level here. We had this trade. I thought that we would come back. So it was something like that. I had the trader here, stop losses tiny here, and I take profits above there. So that is minus, let's see, from here to here. So that's around 11 pips, so minus 11. So yeah, so 140, let's say 140 to 130, depending where you got the entries and etc. So that's pretty good trades. Did you guys got that yesterday? So Peter say, hello Luca, nice to be here again. My trading style was similar to Duncan Cooper. How come nowadays he doesn't do live sessions, blogs? I think he went, to another place. I'm not too sure about. I didn't had too much of a connection with him, but I can investigate that for you if you wish. Okay, cool. So let's go for now what matters the most for us, FinLogic's sentiment tool. Okay, so very, very simple here. What I want you guys to do is come to the FinLogic's website. I'm going to send the link into the chat so you guys can just click on it. Very simple. Onto there, what you're going to do is you're going to come to the top panel here into tools. Just scroll your mouse onto tools, or if you are into the computer, that's completely fine as well. Sorry, if you are into the mobile version. Oh my God, the word just went out. If you are on the mobile version, you can also get it. Okay, so you just scroll at tools or click into tools and then come into market sentiment. Wait that to load because it take a few seconds. There we go, fully loaded. Yeah, okay. US dollar, Japanese yen just became neutral. Interesting. All right. First thing, FinLogic Sentiment 2 updates every 15 minutes. As I speak, it's updating. There you go. Nothing much, change it. But you can see right here, last update was today, July 16, at 4:15. Okay, so that's already every 15 minutes. Cool. So the main ones here is what I want to do is for some of the people that haven't been into the webinar yesterday, because I'm looking at the names here and a few of them weren't here yesterday, and that's completely fine. You can still rewatch the YouTube playback. you can rewatch because it was recorded onto the YouTube channel. So what I want to do today is I want to be nice with everyone, okay? And I want to grab the trade ideas that we had yesterday and try to reformulate them into a way to people that haven't joined the trade yesterday to join today if they want, okay? So that's for the reason I've chosen exactly the same one. So euro dollar, pound dollar, Aussie dollar. And I've added US dollar, Japanese yen. When I did the webinar preparation, like 340, that were available. It wasn't neutral. Okay, so basically I think it changed it, but that's fine. We can still work with that because, as I say, the minority is still short. So what we want is to go long, but that's fine. Cool. So let's go for euro dollar first. Euro dollar has been one of the most strong moves, in my opinion, and I believe we can possibly come back even lower. Okay. I think we can still, I think we can start to look around levels of 115. Yes, 115. That's correct. You didn't heard it wrong. So all the way from pretty much 119 down to 115. That's what I'm expecting to happen. Okay. So if we look here, let me just change this color to maybe white. So I'm looking to target this white line, okay, 1.15. Cool. So if we look at the sentiment tool, euro dollar is actually into a buy state, okay? I'm going to be honest with everyone. I wouldn't trust much on this buy just for the sake of CPI, okay? As I say, majority of the traders are short already. So as usual, what we would do is we would do the opposite. But due to the volatility on the market and due to the lack of positioning into the market, I still believe that we can continue to go lower. Okay, so what I would do is I would wait for, I would wait for a little bit more of a retracement. Where's my pencil? There you go. So we had this huge move down. Okay, it was quite big actually, this whole move here. It's majority of the red candles. And now we have this shiny pullback. Can you see the difference between a explosive move like this one to a very shiny pullback like this one? So that's basically showing to me that the momentum is still in favor of short. Okay. Another example would be just this one here. If you zoom in, can you note that it took 1, 2, 3 candle to go, let's say how much that was, to go 5 pips up, and it took literally 1 candle to go 5 pips down. So the momentum is still in favor of bearish, okay? And we need to take that into consideration. Why is that? Because when we look at these sort of pullback, very shy pullbacks, what we can expect is a pullback about 50% of the trend. So let me just get the Fibonacci. So from the top here, right here, where's the Fibonacci? I thought I got this. What? Oh, there you go. Cool. So from here down to here. Okay, so it's the opposite way. What? That never happened. But I did that right. Let me try it again. I think, oh my God. Now it's wrong again. What am I doing? Let me try again. I think it lagged. Oh, there you go. Now it's right. I was like, what? Okay, good. So what we can expect is a retracement at around 38 to 50%. Okay, so what I would suggest and what I would be looking to do is prepare trades around the levels of here. Let me change that to red so it's pretty, you guys know. So if we look at here, we can see that around the levels of 38 to 50 would be a great possibility to short, okay? And why do I say that? Well, remember, the momentum is still bearish, okay? Very, very bearish. So a pullback around 38 to 50 would definitely work out pretty good. How can you enter that trade then? Well, as I say, this webinar, we looked for the best, just the best low risk setups and high reward. So what I would do is I would do a entry around this level, nearly reaching 50%, stop loss above the 61, and the take profit down at 1.15. Okay. So we would nearly have 156 pips into one trade. Of course, this trade would take time. All right. It's not going to be like a boom. That's it. Okay. No, it wouldn't be like that. It would definitely take a week or so to sort of go in the flow, and then, it may have some of the pullbacks in the middle of the down move, but still, it's a pretty good setup. Now, if you're not that savvy around low risk and high reward setups, because they are a little bit more high risk, because the stop losses are tight, so therefore the market doesn't have much room to move around, to jigger around. What I would do is I would wait for the 50 to 61% of Fibonacci levels, so around here. And I would place my trade around the 61 level and my stop loss about above the 80, but the take profit down at 1.15. Okay, so still a very high reward setup, about 171 pips profit to 32 pips stop loss. So that gives you a risk reward of, if you're risking $100, you're probably going to get back around $523. And as of here, if you're risking $100, you're going to get back 700 and pretty much $800. Okay, that's gross. You wouldn't need to deduct the net fees. So you would need to deduct the swap fees, because most likely we're going to get charged triple swaps on Wednesdays here, as we're going to be staying for a while into the market. Okay, cool. So that's going to be my first trade idea. For those who didn't catch the move from 1.16700, actually 1.16900 down to 1.16, so pretty much 100 pips. What I will do, what I would recommend is you guys pay attention for pullbacks into euro dollar to maybe get into a second opportunity. Okay, these will be my trades around these levels. Again, this one here, it's a little bit more of a high risk. Why do I call high risk when it's still, lower risk than this one? Because high risk is not the setup, it's the risk that has to do with the market. So with a tight stop loss, as of this one has only 19 pips stop loss, well, pretty much 20 pips stop loss, so 200 points. We're talking about a very sudden move that can trigger your stop loss. As of this one has nearly the double of the stop loss. So the market has double of the move to move around. Okay. So that's basically the main reason why I call these those ones. So it says I caught my first move from 1.17503. 1.17503. So you short from 1.17503. And that's really good, man. That's awesome. How much is that? Let me check. 503, somewhere around here. So we're talking about 129 pips. That's pretty good. and second entry from 1.173. 1.173. Yeah. Oh, so you got 2 entries. That's good. Yeah. As I say, the market is full of opportunities. It's just a matter of waiting the right moment. Okay. Cool. That being said, let's get things rolling. TP at 1.17. Oh, you already got out then. Okay. Interesting. Cool. Now, second option is the pound against the US dollar. Okay, so the pound against the US dollar is giving us a short option. Okay, so that is completely I would say correct with what we would be looking to do. So there's only 29% of the market short at the moment. So we would do a short positions into GBPUSD. Let me drink some water. The entries I'm using today, I've listed all of those entries into my top 4 strategies, Forex entry strategies, okay? And you can find them into into education. So if you come to education, go into my name, you can find right here 4 Forex entry strategies that actually work. And you guys know that works because I've been using these. The one that I've just used is the Fibonacci, okay? Right, this one. So I've used this one, and I'm gonna use again for the pound against the US dollar. Okay, so let's say you didn't took this entry, beautiful entry here. Let me just delete that, and you want to have a second go into the market. Okay, you looked at FinLogix, 29% only short, so that's a good good signal. Now, what we need to do is wait for a retracement. Is that happening? Well, sort of. It's more like a consolidation happening at the moment than a pullback. So what we need to do is identify the last broken low because we are on a bearish trend. So this has been the last broken low. The price is 1.34 220. Okay, so 220. From there, what we should do is look for Fibonacci. Okay, so from the top to the bottom, where is the 50% of that Fibonacci? It's right at the break of the last lows. Okay, so sorry, pardon me. So what I would do is it's a perfectly match, okay, because the last broken low serves as a support, was a support and now is a resistance because it got broken, and it got broken very abrupt momentum. Okay, so it's very strong. With that, we do have the 50% of the Fibonacci, so that's the second confirmation. So what I would do is I would actually wait for a touch into the 50%. So somewhere around here, somewhere around here would be my entry. My stop losses would be around above the 61 to 70, okay? And my take profits would be down at 1.33 right here. There you go. So that's pretty much of a 1 to 6 trade. Okay. So you have 121 pips take profit and 20 pips only stop loss. Wow, that's insanely good. That's insanely good. You have 6 times 6R basically. All right. So if you're trading $100 on your stop loss, you're gonna get back 600. If you're trading $10, you're gonna get back $60. So that's really awesome. All right, cool. That's the risky sort of entry. Now, if I want to go for a more conservative entry, and you think that the market can pull back a little bit more, that it possibly could, where the entry I would do is above or at the 61. Okay, so my entry would be somewhere around here. My stop losses would be above the 80, and my take profits would be down at 1.33 as well. That gives you a more actually risk reward. Okay, but it gives you a more confirmation in the sense that the market will come back at 61 and don't go above 80 and then pushes back down at 1.33. Okay, so the second option gives you again a stop loss of 20 pips, so it's very, very similar, and a take profit of 133 pips. Okay, so pretty much, let me see, pretty much 10 pips more. Yeah, 10 pips more. So that gives you pretty much 1 hour more as well. Most likely we're going to get triggered in a few minutes. That's pretty good because London is opening. So it's 4:30 now. We're going to be opening a few minutes, in a couple hours would be actual open, but market's already starting to push back. So that's what we want to see. We want to see a pullback into that area, and then a continuation down. Okay, perfect. Cool. Next one, Aussie dollar. Nice. So let's have a look into Aussie dollar. Aussie dollar says long. Again, we are believing on the strength of the US dollar. So what we want to do is we want to short the Australian against the US dollar. And this trade here is a bit of a hard, a little bit more hard one, because we already looking at the pullback, we can see that it's very, very close to the entry point. Okay, the entry point was here because we've choose to do a break. We've choose to wait for a break of the candle with a momentum candle on the date, on the actual release of the CPI yesterday, to get into the trade. What I wouldn't recommend is having two entries at the same price. You're doubling your risk for no reason. Doesn't make sense. Let me drink some water just a second, guys. So it doesn't make much sense to have double the risk into the same sort of price. You should be looking to spread your risk for different prices, either up or down, but preferably down, in this case, and not up, because then it would become sort of a great strategy or martingale strategy if you're increasing your lot sizes. It doesn't get me, don't get me wrong, it keeps working martingale, but it's you have to be very good at managing the risk as well. So let's move on. What I would do is, this area where we got the trade is fantastically good because we can see that it was like support before, and now it was a support and then a resistance, and now back to support and then breakdown, and most likely it's going to act as a resistance into the next touch. So what I would do is I would preferably wait for the pullback, and if you are into the trade, I would just close that trade with a small profit. Just hear me out. I know it looks crazy, but I would just close that trade into a profit and then I reopen that trade, because then I wouldn't pay triple swaps on Wednesdays, okay? Because this market, most likely what it was possibly happening would be back down here by Monday or Tuesday next week. So I wouldn't, if you are into the trade from yesterday to today, would just close that trade before Wednesday, midnight, and then I would enter the market around this level again, okay? Yes, that's it. Now let's have a look into the Fibonacci. So Fibonacci says that the 50% is exactly where our entry is, and the 61% is a little bit above at 65,500. So sort of a psychological move, but still pretty good. What I would do is, if the market sort of pushes back pretty high and pretty fast and pretty momentum, I would just wait to touch the 61 and then get into the trade. Stop losses above 80, take profit at 65. Done. Okay, very, very simple. Just like that. So if the 61 comes to get rich, just get this out of the way. There you go. My take profit would be down here at 65, and my stop losses would be a little bit above the 80. Okay, it's a good trade. It's not like a huge but still works perfectly if you are looking to re-enter the market. Okay, cool. So just going back again, for Aussie dollar, if you are into the trade already, I would close the trade and reopen the trade at around same price, around 50 to 61% of the FIBO. Targeting the same place at 64,900, 65, around that area, 10 pips difference. If you're not into the trade and you're looking to enter the trade, I would wait for a pullback around 50 to 61% and enter there. Stop loss is above 80 of the Fibonacci. That is around 0.65666, and down, and take profits down to 65. Okay, pretty simple. Now, last but not least, the one that you guys requested yesterday, the little and the bigger US dollar yen. So when we look to US dollar yen, oh, there you go. Just change it. That was massive change. Okay, but I will still look to long that. Okay, so we're going to be looking to long US dollar Japanese yen, and that goes with accordance of the market. So we can see right now that the majority of the market is short, so we want to follow the minority that is long. And let's have a look into the chart. Here we go. Perfect. Well, the targets I had was got hit, and I've mentioned about these targets. So what we can do now is, if we zoom out a little bit and go to the 4-hour chart, we can actually see that we've on the top of the consolidation. Okay, we can see right here. Let me take out those things. There you go. It's not working. Just take that out. Okay. So if we look, what we basically did was we bounced back from the support of the consolidation right here, and we went all the way up to the resistance of of this consolidation. Okay, so it's a really tricky one here, because we don't want to long on the top of the consolidation because it's on the resistance, but we want to miss the trade as well. Okay, so what I do in those scenarios is, let me just mark down here, somewhere around this. Okay, we can clearly see that we had a breakout above, break up. Okay, we can clearly see that we had a break above the resistance of 148, around 148. What I would expect the market to do is a natural reaction to pull back around these levels of 148. Okay, so let me just 148. So 148 would be the level of what I'm looking to basically trade. Okay. So we would need to have a little bit more retracement into this area, and we could enter the long position with the stop losses below, maybe that for the risky entry, the stop losses below this just previous low here, and the take profits would be a little bit above on this area. For US dollar yen, my targets, I would have to go to 4 hours to actually see the next high. But if you can see right here, we have a box. Okay. And the middle of this box is somewhere around here. So this would be my target. Okay. So looking to target, maybe we won't have the chance because it's very close to take profit, but that would be the entry. Okay, come back down to 148, stop loss below the 147,500, and take profit at 149,700. Okay, 149,700. That's for the risky entry. Now, for the more sort of conservative, but still giving you a quite good RR, this one, in instance, is giving you 52 pips stop loss and 175 pips take profit. So it's pretty decent. For the other one, I would enter at exactly the same time, but with the stop losses below this area. Okay, so for the first entry, the stop losses are below the 147,500, and for the second entry, the stop losses would be below the 147 pretty much, or at 147. So it doesn't even give you a little bit below, above, sorry. Yeah, so it's not the best, okay? I would suggest this one would be the best approach for us to actually enter to the market. But it gives you 166 pips take profit and 87 pips stop loss. So yeah, a bit of a more room for the market to jiggle around. I reckon it won't be needed, okay, to be honest. But we have to check how this will go going forward. Good. Now, just going back over again, so we had euro dollar shorts, we had the pound dollar shorts, we have the Aussie dollar shorts, and we have US dollar yen longs. So if we go back into the trades, so euro dollar, we have this beautiful shorts waiting for us. One at the 50% of the Fibonacci retracement, the other one at the 61% of the retracement. Both of them are really good risk to reward. So one of them give you 1 to 1.1 to 8 R. The other one gives you 1 to 5 R. Now, when we go for the pound dollar, it's nearly getting triggered. So one gives you 1 to 6 R, the other one gives you to 1 to 6.6 R. Okay, so not quite a big difference, but still, if as the market is moving back with very strength, as we're looking at, we're probably going to get triggered in a few minutes. That sort of move up is expected to 61. Okay, so just don't forget that. Then we have Aussie dollar against the US dollar. Pretty good trade as well. We're expecting basically for the market to come back down, to come back up at the 50%. For those who already have the trade on, what I would suggest is closing the trade to don't get swap fees placed, and then just open the same trade into similar price around the 50 to 61%. Stop losses would be above 80 if you enter into the 50%, if you're entering into the 61%, and the stop loss would be above 70 if you're entering at 50%. Take profit around 65 to 64,900. Okay. And last but not least, the tricky one today would be the US dollar yen longs, okay? Trying to follow that long, so waiting for a pullback around 148. Stop losses for the risky trade would be at 147,550, and the take profit for that would be at 149,700. Both of them are good trades. It's just, we're trying to wait for a pullback around the resistance that was being broken and now serves as a support, and we're chasing the box retracement at 149,700. Both of the trades are good, except for, well, the risky trade are better than the sort of conservative trade. It gives you 167 pips take profit and 52 pips is stop loss. As of the other conservative trade gives you only 166 pips take profit and 87 pips is stop loss. But it's that where you have to measure and see what is better for you. Cool. So that's pretty much for today, guys. Do you have any questions? What's my take on PPI? Well, I would talk about that tomorrow because the release is tomorrow, if I'm not wrong. It's actually today. Okay. Yeah, so the PPI, I think it's, as we could see, the inflation is more sticky into the tariff front of any other thing, okay? Because when we look to the actual release, we seeing that furnishers and that kind of things are getting more tariffed, and therefore they're the ones that are driving inflation of household costs, etc. I think with that, we can see that the PPI will be somewhere around 0.2 to maybe 0.3, okay? But not much higher than that. If the PPI actually comes at 0.3, then it's just going to fulfill the move of a higher inflation. And for that reason, most likely the US dollar will continue to push up for the market, okay? And all of those trades would be perfectly working in accordance. That's what I think. Awesome. Guys, thank you so much. I hope you guys have an awesome day, finishing off the day, or, it just depends where you're at. I will be here tomorrow, back again from 4 to 5 p.m. We're going to be talking about the wrap up of the week. So bring your questions tomorrow and we can definitely have a chat. Thank you all. Have a great evening, and I'll chat to you tomorrow, guys. Bye-bye.